My name is Brad Stumpy. I'm a partner and the practice leader for financial institution compliance and loan review services at Anders. I'll be joined today by Sadie Carrera, Sandra Lane, and Jessica Likey, who all specialize in loan compliance and have anywhere from a dozen years in the industry to nearly 3 times that. Before we get too far into this, I want to point out that if you'd like to download the materials, there's a link to the slides in the chat. So we'll also send them out with the recording, but if you want them sooner, so now, here's your chance. At the conclusion of our May webinar that covered the now stalled 1071 small business loan data collection rules, we asked what topics you would like to see in future webinars, and the winner was, you guessed it, flood insurance. So ask and you shall receive. As with the 1071 webinar, I'll kick things off, hand it over to Sadie about the time I think you're getting tired of my voice, then I'll circle back to close things out. Also similar to the 1071 web session, we'll keep you muted to help minimize background noise. And with nearly 150 registrants, I don't think there's quite that many on yet, but that's how many had registered. We won't be unmuting individuals to ask questions or monitoring, for the virtual raised hands. You can submit any questions using the Q&A tab, which is a little right of center at the top of your screen. So please use this Q&A feature and not the chat for your questions. Sandy and Jess will be monitoring the Q&A room and answering your questions on the fly to the best of their ability. I'm sure that you're going to have some doozies for them. So with that, we'll say goodbye to Sandy and Jess as they duck into that room and get ready for your questions. The second slide outlines the topics we'll be discussing today. We're obviously not going to cover all of the intricacies of flood insurance in a 1-hour session. And since our initial focus of this series is on emerging issues, our thought was to cover some of the interagency Q&As that were published in May of 2022. So over a year ago, and I know maybe not, emerging, but the past year has given us an opportunity to see which of these 144 Q&As we receive the most questions on and which come into play while we're in the field performing flood insurance audits. So yes, you heard me right. There are 144 Q&As, or a dozen. Where I come from, we call that a gross. And in this scenario, that adjective may well be a double entendre. That gross of Q&As is broken down into 19 sections. We'll cover one or more Q&A from the 11 sections that are listed here, so we'll not hit all of them. So to circle back a little bit to the emerging issues topic, some were surprised that flood finished so high on our poll of what you wanted to hear about. I could be wrong, but I think that's because set their scope, the flood regs rarely, if ever, get scoped out. And it's also the most frequent reason that civil money penalties are assessed. By our count, since the beginning of 2022, 32 banks have been assessed CMPs totaling almost $6.5 million. And that ranges from a low, and it's very low, of $1,500 to a high of nearly $3 million, averages out to just over $200,000 per CMP. So that number is a lot lower for community banks, as there are 2 penalties for over 2 million that skew the average. But oftentimes, I really do think it's the inconvenience and staff time and the public nature of it that hurt more than actually writing the check. So we're about ready to get started, but before we do, let's throw out our first survey to get a feel of how large everyone's flood portfolio is. So we have the survey coming. There we go. All right. So just let us know how many flood loans your institution services. Is it less than 25? Is it between 25 and 100? Or is it over 100? If you don't know, there is a category for that as well. So it looks like it's a pretty even spread, and most seem to know. All right. So we're looking at, it's pretty even, 37% right now at more than 100, 36% at 25 to 100, and 33% at less than 25. And since I started reading that, it all became a dead heat. So a real good variety as far as how large the participants' portfolio is. So thank you all very much for participating in that. All right, so we'll begin with our first Q&A. So note that in the header of these slides, the top line will be which of the 19 sections of the Q&As that you can find the full text. So many of those we have included here, and particularly the A's, are summarized so we could fit them on one slide or maybe just address a certain point that we wanted to bring out. So this question is from section 1, determining the applicability of flood insurance requirements for certain loans. And within the Q&As, this is referred to simply as applicability, which you'll see is the first line in the body of the slide, along with which Q&A it is within that section. And the numbering of the Q&A starts over at 1 within each section. So we're beginning with question number 2 from the section on applicability. To go back in time a little bit, I first started reviewing flood files back in 1992, and this question has been floating around ever since, or some form of it. Come on, Brad, Farmer Johnson wouldn't replace that old barn if it washed away. It's in such bad shape that it probably detracts from the value of the property. So, have any of you heard something along those lines from one of your loan officers? While this argument might sound logical to many of us from a common sense standpoint, others have what they consider a common sense reason for requiring insurance. And I'm not going to get into which argument makes more common sense, but rather we'll talk about what the rule and the guidance says. And it essentially says that if an insurable structure, so think walled, roofed, and attached, is 1, in a special flood hazard area, and 2, in a participating community, then it must be covered by flood insurance unless it is eligible for the detached structure exemption. So the detached structure exemption is a whole nother Q&A. Look to exemptions number 1 for that. But for a refresher on the concept, a structure is eligible for that exemption if it is A, used primarily for personal, family, or household purposes, not commercial. B, is not intended to be or not actually used as a residence. And C, it's literally detached from the primary residential structure. So there cannot be any structural connection between the two. So to clarify point A a little bit, primarily for personal purposes, an example would be a detached garage, and you're using it primarily to park your personal vehicle, store your personal lawn equipment, keep your woodworking tools that you use for personal purposes. That would be eligible for the exemption. If you use that same garage primarily to store tools and supplies for your home improvement business, that would not be eligible for the detached structure exemption. And then to clarify point B a little bit, cannot serve as a residence. So an in-law cottage or maybe a garage that you redesigned into an apartment for your kid that just won't move out of the house, those would not be eligible for the exemption because they're actually being used or they're intended to be used as a dwelling. So if that detached structure includes some, one more, especially more, the harder it is to justify, but sleeping, bathroom, or kitchen facilities, be ready to explain how it's not intended to be or actually used as a residence. So the Q&A also talks about the possibility of carving out the structure from the collateral property, but also cautions lenders to analyze the risk of doing so. And quite frankly, this is an option that we rarely see used, but it is out there if your particular situation, warrants it and it's feasible. So in short, if an insurable structure is in a special flood hazard area and in a participating community, then you're taking your chances by not insuring it if the detached structure exemption does not apply. So our next Q&A is also the next Q&A from the guidance, applicability number 3. It also addresses the question, do I have to require flood insurance on this structure? just under a little different scenario. So this is another call that we frequently receive. It's usually some version of, we have a dozen structures that secure this loan. Only a couple of them are in a special flood hazard area. The question then sometimes continues with, and one of them that is in a special flood hazard area isn't even in a participating community. And sometimes it continues with, and the ones that are not in a SFHA adequately collateralize the loan. And then it almost always ends with, do I really have to get flood insurance? So when we're real lucky, both of those add-ons are included in the question. The simple answer to this series of questions sounds a lot like the answer to the first Q&A. If the structure is 1, insurable, again, think walled, roofed, and attached, 2, in a special flood hazard area, and 3, in a participating community, then it must be covered by flood insurance unless you can find an out, such as the detached structure exemption. But let's get a little deeper in the weeds than that. The interagency Q&A is given an example, and we've incorporated that as our next poll. So this one is pretty straightforward, and the poll should be popping up here in a second. I guess we'll find out really if it's straightforward. But go ahead and respond with whichever you think is the best answer. There are 3 different buildings that secure this loan. Which of these must be covered by flood insurance? Is it building 1 that's in a special flood hazard area and is in a special, I can't talk today, and is in a participating community? Is it building 2 that's not in a special flood hazard area? Building 3 that's in a special flood hazard area but not a participating community? Or both buildings 1 and 3 that are in special flood hazard areas? All right. So it looks like building 1 is the most popular answer. Buildings 1 and 3 is a pretty common one as well. So the good news here is that no one has answered building 2. Flood insurance is not required since the building is not in a SFHA. That being said, if you're still concerned about that building flooding, you can require flood insurance coverage from a safety and soundness perspective. You're just not required to require flood insurance. So just like with the detached structure exemption that we first discussed, even though you're not required to require flood insurance for that detached garage that's primarily for personal purposes, you still can if you want. But I'm getting a little off course here. Answer A, or building 1, stands at 68% right now, and that is the best answer. It's in a special flood hazard area that is in a participating community, so flood insurance is required unless you can find it out. For building 3, since it's in a special flood hazard area, you must provide the notice alerting the borrower to that fact. But since it's not in a participating community and flood insurance is therefore not available through the NFIP, the National Flood Insurance Program, you as the lender are not required to require flood insurance. You may decide to require a private flood insurance policy, but that is up to you. So thank you again for participating in that poll. You did a good job with it. All right, so applicability number 3, the answer to it. The text on this slide pretty much reiterates what we just discussed using the example. However, if you look at the full Q&A, it goes on to say that if any portion of a building, note that it says any portion, so even if a tiny sliver is located in a special flood hazard area, then the entire building must be covered by a sufficient amount of flood insurance if the property is in a participating community. So don't confuse that with the scenario where a portion of the lot or the plat, the land where the building is located being in a special flood hazard area, but none of the building being in a special flood hazard area. That might be an instance where you provide additional information to the flood determination company to satisfy them that none of the building is in an SFHA. But if you're able to do so, then flood insurance isn't required. So a little bit of the building in an SFHA, you have to get insurance. None of the building, but part of the land, you do not have to get flood insurance. So to wrap this one up, let me circle back to a portion of the question that we often receive, but that's not addressed in the Q&A. What if the buildings for which flood insurance is not required adequately collateralize a loan? We're just taking the one that's in a SFHA as an abundance of caution, or because it's on the same plat or lot as the others, and it's easiest just to go ahead and take it. The answer to this is that you're required to require flood insurance on that building, even if the others provide adequate support. I won't recommend it because I don't want to recommend putting yourself in a less collateralized position, but we often get asked as a follow-up, what if I just release that building? If you can do it, then the flood insurance problems go away. All right, the final Q&A from the applicability section that we'll cover is number 12. The bad news is that this scenario comes up more often than we'd like, but the good news is that it rarely goes bad for the lender. So typically this arises whenever Congress is slugging through one of their budget battles, and we don't ever expect that to happen again, do we? But there's a lapse in authorization or appropriations for the National Flood Insurance Program, so new policies cannot be written. The guidance in the Q&A closely follows guidance issued by the Federal Reserve, many, many years ago, but it's much easier to find here, and then also it's on an interagency basis, so that's good as well. What you for sure have to do is still perform the flood determination, and if the property is in a special flood hazard area, then provide the appropriate written notice in a timely manner. Then it's up to the lender to evaluate and manage the risks. For example, you may decide to take one course of action if the property is a Florida vacation home, especially this week, and a different course of action if the property is in an area that you're less worried about flooding during a particular time of year. And that's a very simple example. There's a lot more credit risk factors to consider than that, but you don't have to treat them all the same. Your options then are listed on the next slide. First, you could always choose not to originate the loan. Sorry, Brad, your house is in a special flood hazard area. Your congressman is holding up the budget process, so you can wait to get your loan until funding is reauthorized. So if that's the answer you give me, I'm probably not going to like it. I'll throw a fit. I'll threaten to move all my business to the bank across the street. But I have the coastal home in Florida, and Hurricane Sadie is barreling straight for me. So the last thing you want to do is originate the loan this week just to deal with whatever mess the hurricane leaves next week. So in that scenario, you could choose option 2. Okay, Brad, we can originate your loan, but you're going to need to talk to your insurance agent about getting a private flood insurance policy. We don't see that a lot, but it's out there as an option. Option 3 at the bottom of the slide is what we see most often. So you're going to need to assess the risk in the given situation and then make your own decision. All right, Brad, we love you, or at least we love all the business you bring us, so we'll make the loan. But as soon as your congressman releases his stranglehold on the budgeting process, you'll need to get a flood insurance policy. And if you don't, we'll have to force place it, and that could be more expensive than if you bought it yourself. So I think that is all we'll cover for applicability. And next we'll move on to section 2, exemptions. So this section is officially titled Exemptions from the Mandatory Flood Insurance Purchase Requirements, but again, it's shortened to exemptions. So Q&A number 2 in this section refers back to the detached structure exemption that we touched on earlier, and imagines a scenario where the primary residential structure is not taken as collateral, but where at least some of the detached structures related to that primary residential structure do secure the loan. So as the example alludes, we most commonly see this with agricultural property when various structures are dispersed over a larger area and not so clustered together. So we have the primary residential structure, over here, and various detached structures scattered throughout. The property is situated such that we take what is usually the farmland that includes some of the detached structures as collateral, but not the smaller parcel that includes the home. So are these detached structures eligible for the exemption, even though the home does not secure the loan? The short answer And how often do you get a short answer when you ask a compliance question? Particularly if you ask me a compliance question, but the short answer is yes. Those detached structures are eligible for the exemption, but you do have to take a look at each one, and only those that, A, are used primarily for personal purposes, and B, are not intended to be or not actually used as a residence would be eligible for that exemption. So the garage where the homeowners keep their personal car would likely qualify. The barn, storage shed, silo that are used in farm production would in all likelihood not qualify. To recap, not having the primary residential structure as collateral does not automatically disqualify the detached structures from the exemption. You just have to evaluate each building to determine whether the exemption can be applied in that instance. All right, next up, we'll stay in section 2 with exemptions and take a look at question number 5. We just can't seem to get away from the detached structure exemption, which is fine. We get a lot of questions in that area, and that's why we included these Q&As. But before we jump into the meat of this question, let's make sure everyone is familiar with what constitutes a triggering event. We often hear reference to the acronym MIRE, M-I-R-E, in regards to what constitutes such an event. That stands for make, increase, renew, or extend. So each time one of these actions is taken on a loan, it triggers certain requirements. So let's say I came in and got a loan from you a few years back to purchase several acres of recreational property. Include an old farmhouse up on a hill and a couple of outbuildings lower on the property near a creek. And surprise, surprise, those outbuildings were in a special flood hazard area. So being the knowledgeable lender that you are, you asked me, Brad, what do you use those outbuildings for? My response was, I don't know what we're going to do with the old tool shed. It's empty, pretty rough. We might just tear it down. The barn is in pretty good shape, though. We're going to keep the four-wheelers and fishing equipment in there. So based on this response and no evidence to the contrary in the file, you did not require flood insurance on the tool shed or the barn. Fast forward a few years, I receive a notice in the mail that the loan is coming due. I call in to say I'd like to renew it. Oh, that's great, Brad. We'd be happy to renew that loan for you. How are you liking the property? Do you get much use out of it? My response is, oh, we love it. Our daughter and her family are down so often that they've turned the barn into their own little retreat with a couple of bedrooms, a little kitchen. Oh, there is a question you wish you could take back. What are your obligations now? Well, even though you wish you could take the question back, you shouldn't. Each time there's a triggering event, you are obligated to examine the status of a detached structure for which you have waived the requirement for flood insurance under this exemption. So in this example, one way or the other, you need to determine how that tool shed and barn are being used now, and then document how you made that determination. So there's no requirement to monitor the status of these detached structures absent a triggering event. So think MIRE. The guidance does state that sound risk management practices may lead you to do so. Take that for what it's worth. In my humble opinion, if the value of the detached structure is significant enough to the viability of the credit that you're worried about flood damage, then it's perfectly fine to require flood insurance. Nothing prohibits you from making flood insurance on that structure a condition of the credit. You can just use this exemption as an out if you want to. So, no need to continuously monitor, just verify upon a triggering event or a MIRE. And did I mention, be sure to document how you made that updated determination. All right, with this slide, we'll move on to section 3 of the Q&As, which is titled Private Flood Insurance, Mandatory Acceptance, and is abbreviated as mandatory. 3 different sections of the Q&As address various aspects of private flood insurance policies. We'll cover a couple from each section, and then I'll hand over to Sadie. So to put things in perspective, a few years ago, we rarely saw a private policy. Now it's more unusual to go into a shop that has more than a handful of flood loans and not see a policy. They're becoming quite common. So we'll begin with question number 4 from the section on mandatory acceptance, which deals with the compliance aid statement. To be sure everyone is familiar with the compliance aid statement, let's cover a brief history of what that is. So back in 2012, the Biggert Waters Flood Insurance Reform Act obligated the agencies to issue a rule that required lenders to accept private flood insurance. When we first started seeing private policies, the primary issue was that lenders could not demonstrate they had reviewed the policy and determined that it met the more than half dozen requirements to be deemed acceptable. It was not an easy job to do that. We didn't like doing it. We even saw some third-party companies begin offering that review as a service. God help them. But fast forward to 2019, when the final rules introduced the concept of a compliance aid statement to try and make this process easier, and I think it has. So now, if a flood insurance policy or an endorsement to the policy includes a statement, and we'll do the air quotes, this policy meets the definition of private flood insurance contained in 42 USC 4012 AB7 and the corresponding regulation, and the air quotes, you can rely on that, and you're not required to perform any additional due diligence other than, is the amount correct? And that, my friends, is a brief history of the compliance aid statement. All right, so back to the question at hand. Are you required to accept a policy that includes the compliance aid statement? Unfortunately, most of these Q&As are not a simple yes or no. You are not required to accept the policy based solely on the inclusion of the statement. You may choose to make your own determination about whether the policy meets the requirements, but absent you making a determination that one or more of the requirements was not met, then you must accept the policy, thus the term mandatory acceptance. So while we get the question occasionally, we've got this private policy, do we have to accept it? I'll then ask, does it have the compliance aid statement? Yes. Is the amount correct? Yes. Can you work through all the requirements for a private policy and demonstrate that it doesn't meet the test? Never mind, I'll accept it. So I'm knocking on wood as I say this, but I have not heard of a policy that includes the compliance aid statement that was later deemed not to meet all the criteria. However, if something doesn't look right to you, by all means, investigate and start asking questions. The second part of this question may require that I knock on wood once again, but it's also very unusual to see a private policy without the compliance aid statement. And that being said, if you do receive such a policy, you cannot reject it simply because it does not include the statement. Question number 7 digs into this a bit deeper, and I bet you can't guess which question we have on the next slide. So there are mandatory acceptance standards, and as the name implies, if these are met, you must accept the policy. It's mandatory. And there are discretionary acceptance standards, so something other than mandatory, but good enough that you can accept at your discretion. Since there may be a scenario where you prefer to accept a policy under the discretionary provisions, maybe you think it's just easier. This question asks that in the event a policy issued by a private insurer does not include the compliance aid statement, is it acceptable to run it through the discretionary tests instead of the primary tests? And the answer here is a simple yes, with a qualifying but. If the policy does not meet the discretionary acceptance provisions, then you'll need to roll up your sleeves, dig in, and determine if the mandatory acceptance provisions are met. So keep in mind also that if you accept such a policy under the discretionary rules, you'll need to document that the policy provides sufficient protection for the loan. This documentation can be written or electronic, but it does need to cover items such as, is the deductible reasonable based on the borrower's financial condition? Is adequate notice of cancellation provided to allow for the timely forced placement of flood insurance? Are terms with respect to limits on payment per loss and in the aggregate adequate to protect the lender's interest in the collateral? Does the policy comply with applicable state insurance laws? Does the insurance company have the financial strength, solvency, and ability to satisfy claims? So as you can see, it's no small task to determine and document this. This leads right into section 4, and that's titled Private Flood Insurance Discretionary Acceptance. That's abbreviated as discretionary. The first and only question that we'll cover from this section is number 1. Are you required to accept a policy under the discretionary acceptance criteria? This may seem like an odd question, but there's been a lot of hypothetical what ifs and confusion surrounding the issue. But the regulatory powers that be smiled, they wrapped their arm around our shoulders and said no. As the name implies, it is at the lender's discretion to accept the policy under the discretionary provisions, so long as the policy does not meet the mandatory acceptance criteria, then it's mandatory to accept. So, as I may have mentioned before, in our world, it is unusual to see a policy accepted under the discretionary acceptance criteria. So our next poll is meant to get a feel of how well our world meshes with your world, and simply ask if your bank or credit union will accept a private policy using the discretionary criteria. So if you know yes or no, please respond with that option. If you truly don't know, then we have some fun and you can choose the third option. Thank you to Sadie for that fun third option. And as the answers are rolling in, so we do see right now, half of you will accept a policy under the discretionary criteria. All right, well, that's interesting. I wish we had another poll that said how many of you have instead of how many of you will just allow. So that's good. That is good to know. We will keep our eyes open for that. Maybe we'll start asking about it a little more when we come in. And then 12% of you took Sadie's fun answer. Very good. Giggle, giggle. All right. Once again, appreciate you participating in that. All right, so the next and final 2 questions that we'll cover, which are exclusive to private policies, come from section 5 of the interagency Q&As. That's titled Private Flood Insurance General Compliance. It's abbreviated as Private Flood Compliance. So deductibles have long been a common question with flood insurance, and the frequency of those questions has increased as private policies have become more prevalent. So it does make sense that the first question in this section deals with the maximum deductible for private policies. I just wish the answer for private policies was as simple as it is for standard flood insurance policies, or SFIPs. For private flood insurance, the answer will be a bit different based on whether the policy was accepted under the mandatory or the discretionary provisions. So for mandatory acceptance, the deductible cannot be larger than the maximum deductible allowed under a similar standard flood insurance policy at the time the policy is provided to the lender. So that's a mouthful. If something doesn't look right, then it probably is a wise move to get something from the agent showing what the deductible could be for the same NFIP policy. Now, if it looks unusual to you, it probably will to an auditor or to an examiner as well, and that way you'll have support in file and ready to go rather than trying to justify it 3 years down the road when it gets picked up for a review. So many private policies, though, are for an amount in excess of what could be obtained through the NFIP. If that's the case, then a private policy that was accepted under the mandatory provisions can have a deductible that exceeds the maximum for a similar NFIP policy. And here by similar, I mean residential or commercial, building coverage, contents coverage, but you should be able to show that the deductible is reasonable based on the borrower's financial condition and what type of risk the deductible would pose to both the borrower and to the lender. So how the borrower will be able to weather the storm of absorbing that deductible and still have the capacity to repay the loan. If the policy is accepted under the discretionary provisions, then the deductible can be higher than it would be for a similar policy from the NFIP. so long as you can demonstrate that the policy provides sufficient protection for the loan consistent with safety and soundness principles, which include the borrower's financial condition. So you have more latitude if you're able to accept it using the discretionary provisions, but it will be more work. Now, in either case, mandatory or discretionary, you cannot use a deductible that is equal to the insurable value of the building to avoid the mandatory purchase requirement, just like with an SFIP. One potential difference here, though, is that with a private policy, you could have one that covers multiple buildings. In that case, the mere fact that the deductible is equal to or larger than the insurable value of one or more of the individual buildings does not in and of itself run afoul of this rule. So you'll need to look at that and evaluate that on a case-by-case basis. All right, the final Q&A dedicated solely to private policies that we'll cover today is private flood compliance number 6, which asks whether a multiple peril policy issued by a private insurer can be used to satisfy the mandatory purchase requirement. So after the hard work of the last few questions, I'll wrap up my portion of the presentation with perhaps the most straightforward answer you will hear all day. Yes, you can use a multi-peril policy. And with that, I will give your ears a break and turn it over to Sadie to cover the rest of the Q&As, and I'll be back at the end to wrap things up.
Thank you, Brad. Good morning, everyone. I'm Sadie Carrera. I'm a compliance supervisor with Anders CPAs and Advisors. Brad covered quite a few new questions and answers issued in May of 2022. And I'm going to cover a few more regarding the standard flood hazard determination form, the amount of insurance required, requirements of flood insurance for construction loans, helocs and seconds, escrow, and some forced placement of flood insurance questions. So the first being a special flood hazard determination form, and this is question number 7 within that section. May a lender rely on a previous determination for a refinancing or assumption of a loan or multiple loans to the same borrower secured by the same property? And the short answer is not a short answer. It depends. If we have the same lender, same borrower, same property, then we have 2 conditions that need to be met. The first condition is the previous determination cannot be more than 7 years old, and we cannot have any map revisions or updates. So let's talk about those conditions. Let me give you an example. I have a renewal that's set to renew on September 15th. Okay, it's now August 30th, and I'm doing my prep work for that renewal. One of those things that I need to do for prep work is look at my flood hazard determination form and see if that flood hazard determination form that was last obtained was within 7 years. If it's January 2016 and we're now at August 2023, that's obviously more than 7 years. I can't rely on that one. I have to obtain a new determination. If I look at that previous determination and it was obtained January of 2018, well, that is within 7 years. So I can just use that one, right? Well, maybe, but we need to make sure that it meets the second condition, which is no map revisions or updates. So typically, we rely on our life of loan determination companies to notify us of changes in flood zone. However, those companies just might not change or inform us if the map is updated. So we cannot just rely on life of loan determination coverage alone. But what you can do is perform a search on the FEMA website for the address and current map number and see if any revisions or updates have been completed. If they have, even though it's within 7 years, you have to obtain a new flood determination form. If not, then you're good to go. Now, a reminder, this does only apply to the flood determination form, not the special flood hazard area notice that you need to provide a reasonable amount of time for all triggering events. So that rule is relatively the 10 days prior. So let's go on to our next question. This section is determining the appropriate amount of flood insurance required, and this one's question number 6. It's a 2-part question. Is flood insurance required for each building when the real estate security contains more than one building located in a special flood hazard area in a participating community? And the second part is, if so, how much coverage is required? So let's talk about that for a minute. So first of all, our answer is going to be obviously yes. Every structure in a special flood hazard area securing the loan must have coverage. And that's regardless of condition. So the lender must determine the amount of insurance required on each building and add these individual amounts together. The amount of total required insurance must be allocated among the secured buildings in varying amounts, but all buildings in a special flood hazard area must be covered. So here's an example. You have a lender that brings you an appraisal, and that appraiser gave no value to the dilapidated cabin that's located on the collateral property that's located in a special flood hazard area. We've all had this happen, right? And if that cabin meets the definition of a structure under the rule, so the permanently affixed, walled and roofed, etc., that structure must have flood insurance coverage. A little note, FEMA does not deny flood insurance coverage based on condition alone. So let's do an example of how much coverage we're going to need, right? And how this is allocated. So I have a $90,000 loan that's secured by 3 single-family residents, all located in a special flood hazard area. Insurable value for each home is $50,000. So total insurable value, $150,000. And of course, the maximum coverage under the program is $250,000 for each structure. So now we're looking at what's the lesser of each of those three. That's our loan amount of $90,000. So $90,000 coverage is what we will need total. Now, you can allocate varying amounts just as long as you have $90,000 flood coverage. So you can have $30,000 on each of those homes, maybe $20,000 on 2 of them, and one of them you feel is a little more valuable, so that one gets $50,000. However you do it, it just needs to be total of the $90,000 coverage. Okay, let's move on to our next question, which is also determining the appropriate amount of flood insurance required. This is question number 10. Can a lender accept a blanket flood insurance policy or blanket multi-peril policy covering multiple buildings that includes the per occurrence deductible, regardless of whether any single building coverage by the policy has an insurable value that's lower than the amount of the deductible? The answer here, yes. So you may accept a blanket insurance policy or multi-peril policy covering multiple buildings that includes a per occurrence deductible, regardless of whether any single building covered by the policy has an insurable value that's lower than the amount of the deductible. What you may not do is allow that deductible amount equal to the aggregate insurable value of the property to avoid the mandatory purchase requirement. So here's an example. I have a blanket policy. It covers 10 structures for a total aggregate insurable value of $1 million. So that's $100,000 per structure, right? The deductible must be less than $1 million. It can be more than the per occurrence $100,000 per structure, but it has to be less than the total aggregate $1 million. So coming to the second part of the question, how much can a deductible be in this example? Well, the rule says that the reasonableness of the deductible should be determined on a case-by-case basis. So you have to take into account the risk that any such deductible would pose on both the borrower and lender. Now, if we go on to our next question, this is flood insurance requirements for construction loans. This is question number 4. When must a lender require the purchase of flood insurance for a loan secured by a building in the course of construction that is located in a special flood hazard area and which flood hazard insurance is available? So we get this question a lot. When do we have to get coverage? Well, we have a few choices. The safest bet would be to obtain the coverage, adequate coverage, at the time of origination. You're covered. You don't have to worry about it in the future. It's already covered, unless, of course, you have to go into looking into forced placement. But let's get it covered at the beginning at loan origination. If you do decide to defer that, you can defer the insurance until after a foundation slab has been poured. but under no circumstances may a draw be advanced to pay for the building construction, except to pour the slab or perform preliminary site work. Now that preliminary site work is such as laying utilities, clearing brush, or the purchase or delivery of other building materials without having that insurance in place. Now, if we do decide to defer, a little note, if the lender does not require the borrower to obtain flood insurance at loan origination, and we've deferred it, we better have some adequate internal controls to ensure that the borrower obtains flood insurance no later than 30 days prior to disbursement of funds. Because remember, the flood insurance, a national flood insurance program has that 30-day waiting period requirement. So we want to make sure we take that into account before we disperse those funds. 30 days prior, the borrower would have needed to begin purchasing that flood insurance for us. Okay, the next question is requirements for helocs, subordinate liens, and other security interests. This is question number 3 from that section. This question says, what is the amount of flood insurance coverage required on a line of credit secured by the residential improved real estate? And the short answer, well, it's never a short answer, is it? It's 2 different approaches. Okay, we have 2 different approaches we can take. We can require the purchase of flood insurance for the total amount of the loans or the maximum amount of flood insurance coverage available, whichever's less. Or we can consistently and actively review records throughout the year to determine whether the appropriate amount of flood insurance coverage is maintained. So that means you would have to consider any draws taken against the line and then any repayments to the account. That seems a little tedious. Personally, I'd go with the first approach. Well, let's give an example of these 2 approaches, okay? You have a first lien closed end, which is collateralized by a single family residence with an insurable value of $200,000, located in a special flood hazard area, and that loan currently has a $100,000 outstanding balance. That property is also collateralized by a second lien HELOC. This HELOC has a total commitment amount of $50,000, but we only have $10,000 drawn on the line. And of course, the max available under the program at this point is $250,000. So if we take that first approach and we require the total commitment amount of your HELOC and the outstanding balance of the original closed-end loan first, then we need $150,000 coverage. If we take the second approach, which we can, you could only insure the building for $110,000. So that's our original $100,000 on the closed end first, and the $10,000 that's drawn on the second, for $110,000 coverage. Now, if we go with that approach and we have a $20,000 draw that's taken the next day, you're now uninsured because now we need $130,000 coverage and we only have $110,000. So of course, the first approach is always our safest bet. Our next question has to do with requirements to escrow flood insurance, premiums and fees, and that's in the general section. And it's escrow question number 3. Are lenders required to escrow force-placed insurance? Well, yes, of course we are. Lenders or their servicers are required to escrow flood insurance premiums for any residential designated loan made, increased, extended, or renewed after January 1st of 2016, unless, of course, the lender or the loan qualifies for an exemption from that escrow requirement. The Act and regulation do not include an exemption to the escrow requirement for force-placed insurance. So let's just chat really briefly. We know the answer is yes, but what are these exemptions that they're talking about? Well, we have a small lender exception to the rule for escrow requirement, and there's 3 things that have to be met. Your assets need to be less than $1 billion as of December 31st of either of the prior 2 calendar years, and was not required to establish an escrow account, and the institution did not have a policy of consistently and uniformly requiring an escrow account. And some of the loan exceptions, of course, those are primarily for business, commercial, or ag use, a subordinate financing, loan where the first has adequate coverage and is already escrowed. We have a master policy that's being paid by the condo or homeowners association. We have a heloc or a non-performing loan, which those have some additional requirements under the rule. And then a loan that has a term not longer than 12 months. So in our next section, we're going to talk about the forced placement of flood insurance. Forced placement flood insurance question number 4 asks, may a lender satisfy its notice requirement by sending the forced placement notice to the borrower prior to the expiration of the flood insurance policy? And the short answer may surprise you. No. A notice must be sent upon determination that the collateral property securing the loan is either not covered, or the coverage is insufficient. Now, you may go ahead and send a notice prior to the expiration date as a courtesy, but a notice will still be required to be sent upon determining that the flood insurance policy actually has lapsed or is insufficient. So it's probably a surprise to some. I'm going to give an example of this. The flood insurance policy we have expires on October 1st, 2023. Now, a notice can be provided in September, like September 20th, 2023, just as a courtesy. However, you're still going to need to send out and provide another notice that starts that timing requirement upon the lapse of flood insurance coverage, which takes place once the policy expires. So no, can't send it early if you're not going to send one that actually needs to be sent upon lapse or insufficient coverage. And I believe our final question of the day, before I send it back to Brad, and he'll cover our final poll and some closing questions, is again from the section of forced placement of flood insurance. This is question number 10. And the question asks us, does capitalizing the flood insurance premium into the outstanding principal balance constitute a triggering event, an increase that would trigger the applicability of flood insurance requirements? Well, the answer to that is, again, not simple. If there is an explicit provision permitting this type of advancement of funds in the loan contract or note, the capitalization of flood insurance premiums and fees into the borrower's outstanding principal balance would be considered an increase in the loan amount and therefore considered a triggering event because no advancement of funds was contemplated as part of this loan. So let's talk about that for a second. You force place a flood insurance policy. Okay, you have already sent out your notice. The 45 days have now passed, and you have now assessed the premium to the borrower. You accomplished this assessment by adding that premium to the outstanding principal balance of the loan. Now, the note, go ahead and you take a look at that note and you read it over, and it does not seem to contain any such provision that allowed this type of advancement of funds. You now have an increase underneath the rule. That's a triggering event. So what happens? Now your notice provision is triggered, your escrow requirements are triggered, and that means sending out that notice of special flood hazard area within a reasonable amount of time prior to the increase. So now you should have sent that notice roughly 10 days ago because you have already increased and already had that triggering event happen. So that was a lot of information. I want to thank everybody for joining us today. It really is a pleasure to be able to do these for you all. And I'm going to turn this back over to Brad for a final poll and some closing thoughts. Brad, back to you.
All right, thanks, Sadie. Yeah, that's true. That was a lot of information and it was a lot of good information. So thank you for that. So our final poll for the day has to do with what topics you would like to see covered in future webinars. I would say please use a word or a short phrase to freeform your answer. This is a word cloud, not multiple choice. So an overly detailed answer will likely not register very high. TRID, that's brief. So the selection of the topic today, flood insurance, was influenced by the results of the survey at the end of our session on 1071. I'll also be honest and let you know that if the final CRA regs come out in time, there's a high likelihood that CRA will be the topic. But if that's the case, then this poll will still be used to help determine future topics. And if you want more flood or more 1071, it's fine to enter that as well. I see 1071 out there. This was more Q&A flood. If you want basic flood, you can put that, basic flood. So it looks like 1071, and not to anybody's surprise probably, is high on the list right now. TRID is high on the list. HMDA, yep, that'll be coming up toward the end of the year. That'll be important. So even though 1071 is delayed, it is still everyone's favorite topic. Now here comes TRID again. So yeah, keep go ahead and submitting those. We'll keep that poll open, but I'll go ahead and just advance to the next slide because this is important to us so we get what you all want. But before we wrap it up, this slide includes links to what we think may be useful information, and that includes the full text of the interagency Q&As and also the information on risk rating 2.0. And we didn't get into 2.0 here, but it's why you're likely seeing some significant increases in flood insurance premiums. If you have questions on that, feel free to hit us up offline. While Sadie was going through her portion of the presentation, I jumped over into the Q&A room real quick. We had a couple, probably not as many as I expected though, but if you've entered a last minute question and we did not get to that and you still want to talk about it, feel free to be in touch with either Sadie or I. All right, I haven't seen any new responses come in on the poll for a couple minutes, so I think we're going to go ahead and close that down. Thanks again for participating. Then the final two slides are just contact information for Sadie and myself. Again, please feel free to be in touch for additional information if you have any questions. And remember also that a link to the recording will be mailed out to all registrants within the next few days. That will also include the slide deck in case you didn't get it downloaded from the chat. The fact that a holiday weekend is upon us may also delay when that recording becomes available, but it will be emailed out to the address that you used to register for the session. So it looks like we're a couple minutes early. We maybe could have squeezed in one more Q&A, but we weren't sure. Thank you very much for joining us today. It means a lot to us that you took an hour out of your day to spend it with us. Have a wonderful Labor Day weekend, and we'll see you next time. So bye now.